KPMG chief economist Diane Swonk joins us this morning. Diane, I am curious to get your take on, we mentioned retail today and Macy's comments about delinquencies and whether or not you think the consumer is actually beginning to crack this time.
Well, they certainly didn't crack in July. We saw a huge tailwind because for the first time since the onset of the pandemic and prices cratered, that wages outpaced inflation in the second quarter, and that gave us a tailwind entering into the third quarter. And the blistering heat waves pushed a lot of people inside, and everything from theaters with the summer blockbusters to restaurants. And I think that's important. So that's the good news. The bad news is that, yes, credit market conditions are starting to tighten much more broadly beyond just the banking sector, which is a third of overall credit in the U.S. economy. We know rejection rates on vehicle loans, mortgages, and credit cards are all up. I heard one person quoted yesterday on a mortgage rate of 8% because it's so hard for them to qualify for the houses they're trying to buy now, which is really quite stunning kind of interest rate for someone who's got a pretty good credit rating overall. And I think those are the kinds of things, along with the resumption of student debt payments, that are going to slow down consumer spending as we go into the fall. But also the Fed is going to keep its options open. Jay Powell talks on Friday at Jackson Hole, and he's going to be all about optionality. The Fed is either near or close to their peak in rates, but they won't quite declare victory yet. They see combating inflation as a marathon, not a sprint. It has been quite a marathon, and through the proverbial hardest miles so far, it's somewhat emboldened them that it seems to have become more of a relay race, with some of the strongest performing sectors earlier in reopening handing off the baton in the labor market to what were laggards earlier in reopening. And that's given the Fed some confidence to, if they need to, keep going, but certainly holding rates higher for longer.
Diane, and as we look ahead to Jackson Hole, one of the debates that's been cropping up is this idea that there might be a 3% inflation tolerance relative as opposed to the 2% inflation tolerance that the Fed has communicated. You've had some debate about this on X, formerly known as Twitter. What's your take on the actual appetite for the Fed to kind of readjust their inflation target?
I understand Jason Furman and I have gone back and forth on this, and I understand his debate, and I can certainly empathize with it. That said, I think we do need to understand what is an optimal inflation rate for the Fed to target. It's somewhat arbitrary, the 2% target. That said, the Fed is not about to change its target anytime soon. They've really been steadfast in that. And in fact, because we've seen the economy cool much more rapidly now than they expected, they're much more emboldened to get to 2% and defend that 2% target. So I don't think they're going to be as willing to do what Jason says. Now, will they tolerate 2.25%, 2.5% after they couldn't even reach the 2% target from the downside in the 2010s? That may be the case after we get to 2%, but I don't think you're going to see an explicit change in the Fed's target, barring a major reset around the world in developed economies where they actually raise inflation targets. I just don't see the Federal Reserve trying to do that.